What you're about to discover could completely change how you view your money and investments forever. Ray Dalio, the founder of Bridgewater Associates, the world's largest hedge fund, just dropped a bombshell that's sending shockwaves through the financial world. The US dollar fell 39% against gold in just 1 year. That's right, nearly 40%. And according to Dalio, this isn't a fluke or temporary correction. This is the beginning of a structural shift that will redefine the global economy as we know it. Whether you have savings, investments, or you simply want to understand what's happening to the world economy right now, you need to watch this video until the very end, because I'm going to reveal exactly what's behind this historic dollar collapse, what Ray Dalio is predicting for 2026, and most importantly, what you can do right now to protect your wealth from the financial storm that's building. And before we dive in, if you want to keep receiving deep financial analysis and economic insights like this, smash that like button and subscribe to the channel. It helps me continue bringing you this quality content. Ray Dalio isn't just another analyst making predictions on the internet. He's one of the most respected investors in the world, with decades of experience studying historical economic cycles. When he speaks, Wall Street listens. And at the end of 2025, Dalio published a year-end reflection that's being called his most revealing analysis yet. The numbers he presented are absolutely shocking. The US dollar didn't just fall against gold, it dropped 12% against the euro, 13% against the Swiss franc, and 4% against the Chinese yuan. But the most dramatic decline was against gold, with a staggering 39% depreciation in dollar terms. To put this into perspective, if you had invested in gold at the beginning of 2025, your return would have been 65% in dollar terms. Meanwhile, the S&P 500 returned 18%. That means gold outperformed the stock market by 47 percentage points. But here's where it gets even more interesting. Dalio points out that if you measure the S&P 500's performance in gold terms instead of dollars, the stock market actually fell by 28%. Let that sink in for a moment. The stock market went down when measured against real, hard assets. This is what Dalio calls the currency illusion. When your currency is losing value, it makes everything priced in that currency appear to go up, even though your real purchasing power is declining. So what's really happening here? Why is the dollar weakening so dramatically? Dalio identifies several interconnected forces that are creating this perfect storm. First, there's the massive debt problem. The United States currently has $38 trillion in national debt. That's trillion with a T. And here's the kicker. Nearly $10 trillion of this debt needs to be refinanced in the coming years. Think about that. The government has to find buyers for $10 trillion worth of new bonds just to roll over existing debt, not even counting new borrowing for budget deficits. The US is spending 40% more than it takes in revenue. That's not sustainable, and the world knows it. Dalio uses a powerful metaphor to describe this situation. He calls it a debt-death spiral, comparing it to an economic heart attack. Just like plaque builds up in arteries and eventually causes a heart attack, debt service payments are squeezing away the government's buying power, and unlike defense spending or social programs that Congress could theoretically cut, interest payments on the debt are non-discretionary. They must be paid or the government defaults. As interest costs consume a larger and larger share of the federal budget, there's less money for everything else. In fiscal year 2026, the Treasury is already paying out $11 billion per week just to service the debt. That represents 15% of all federal spending, just on interest payments. Now, when a country faces this kind of debt crisis, there are really only 3 ways out. Option 1, default on the debt. But Dalio says the US won't do this because it would destroy confidence in the dollar overnight and trigger a global financial catastrophe. Option 2, raise taxes and cut spending dramatically to pay down the debt. But this is politically almost impossible and would likely trigger a severe recession. So that leaves option 3, the path that Dalio says is most likely. Devalue the currency through inflation and money printing. This is exactly what's happening right now. The Federal Reserve appears inclined to cut interest rates and ease monetary policy to push real interest rates down. This makes debt cheaper to service in the short term, but it also devalues the currency and makes bonds less attractive to investors. And here's the critical part. Foreign investors are noticing. They're losing confidence in dollar-denominated assets. China has slashed its US Treasury holdings to $730 billion, the lowest level since December 2008. At the same time, China and other nations are buying gold at record pace. Central banks around the world are diversifying away from the dollar. This is what Dalio calls a decisive shift in global capital flows. The geopolitical dimension makes this even more complex. Dalio notes that 2025 saw a clear shift from multilateralism to unilateralism. Instead of countries working together through international organizations and agreements, we're seeing nations act in their own self-interest, using economic threats, sanctions, and protectionism. This trend is accelerating deglobalization and strengthening demand for assets like gold that aren't tied to any single country or government. The Trump administration's policies, which Dalio describes as an all-out aggressive bet on capitalism, involve stimulative fiscal policy and reduced regulations to boost domestic manufacturing. While these policies aim to revitalize American industry, they also widen the budget deficit and create what Dalio sees as a fundamental tension. The policies benefit capitalists who capture most of the gains, while workers see relatively less benefit. This creates political pressure that Dalio believes will become the #1 issue in 2026. In fact, Dalio predicts that what he calls the value of money issue, also known as the affordability crisis, will dominate politics in the coming year. As the dollar continues to lose purchasing power, everything becomes more expensive for ordinary Americans. Groceries, housing, healthcare, education. All of it costs more when the currency is being devalued. Dalio expects this issue to contribute to Republicans losing control of the House of Representatives in the 2026 midterm elections, setting up what he calls a very complicated 2027 and a very interesting 2028 presidential election, where the clash between right and left promises to intensify. Now let's talk about what this means for investors and what's coming in 2026. Dalio's analysis reveals that US stocks significantly underperformed both non-US stock markets and gold in 2025, primarily due to dollar weakness and capital flight. European stocks beat US equities by 23%. Chinese stocks exceeded American returns by 21%. Emerging market equities returned 34%, substantially beating developed market benchmarks. This represents a major wealth transfer away from US assets. Investors around the world are saying clearly that they'd rather be in non-US stocks than in US stocks, just as they'd prefer non-US bonds over US bonds and cash. When Dalio calculates expected future returns based on current stock and bond yields, normal productivity growth, and resulting profit growth, he arrives at a sobering conclusion. His long-term expected return for US stocks is about 4.7%, which he notes is below the 10th percentile historically. Compare that to current bond yields of about 4.9%, and you get an equity risk premium that's extremely low. In other words, stocks aren't offering much extra return compared to bonds when you factor in the additional risk. Credit spreads also narrowed to historically tight levels during 2025, leaving little room for additional compression. This was positive for equities and lower quality assets in the short term, but it also means these spreads are more likely to widen than narrow further, which would be negative for these assets going forward. The bond market is sending warning signals too. The yield curve entered 2026 at its steepest level since 2021, with the spread between 2-year and 30-year treasuries reaching 140 basis points. This steepening typically indicates that the market expects either higher inflation in the future, greater uncertainty about long-term economic conditions, or both. For bond investors, the picture is particularly challenging. While 10-year US Treasuries returned 9% in dollar terms during 2025, that return looks very different depending on what currency you're measuring in. In euro terms, treasuries returned negative 4%. In Swiss franc terms, also negative 4%. And in gold terms, a catastrophic negative 34%. Even cash performed worse than bonds. This explains why foreign investors are not enthusiastic about dollar bonds and cash unless they've hedged the currency risk. Dalio also touches on technology and artificial intelligence, noting that the current AI wave is in the early stages of a bubble. He mentions he'll be releasing his bubble indicator report soon. The so-called Magnificent Seven tech stocks, which account for about 1/3 of the S&P 500's market capitalization, saw earnings growth of 22% in 2025. The other 493 stocks in the index also had solid earnings growth of 9%. So the market's gains were broad-based, not just driven by a handful of tech giants. However, much of the stock market's total return came from PE, ratio expansion, meaning stocks got more expensive relative to earnings. This is another warning sign for future returns. Looking specifically at 2026, Dalio sees several major forces continuing to reshape the global landscape. Debt, monetary policy, markets, and economic forces will interact with domestic political forces, geopolitical tensions, military spending, climate change, and new technologies like AI, to create what he describes as following the long-term cycles framework he outlined in his book, Principles for Dealing with the Changing World Order. This framework is based on studying centuries of historical data about how empires rise and fall. Dalio has identified 7 archetypal stages that every dominant power goes through, from rise to peak to decline. And many of the indicators suggest the United States is in the later stages of this cycle, while other powers, particularly China, are still ascending. So what should investors do with this information? Dalio is careful to say he doesn't want to be anyone's investment advisor, but he does want to help people invest more effectively. The most important thing, he emphasizes, is developing the ability to make independent decisions. You can infer his positioning from his logic, and that logic points clearly toward diversification away from dollar-denominated assets and toward hard assets and international diversification. Specifically, Dalio has long recommended holding 10 to 15% of a portfolio in gold. His reasoning is simple. Gold can't be printed like fiat currency. It's not tied to any single country, government, or economy, and it has been valued as money for thousands of years across virtually every civilization. As Dalio puts it, there's a saying that gold is the only asset you can have that's not somebody else's liability. When you hold physical gold, you're not dependent on anyone's promise to pay. You own something with intrinsic value. The gold rally to over $4,500 per ounce in late 2025 occurred despite higher real interest rates and a stronger dollar at certain points, conditions that historically suppress gold prices. This inverse correlation breakdown suggests the gold market is pricing in something far more severe than normal inflation or currency depreciation. It's pricing in systemic monetary breakdown. The World Gold Council noted this unusual pattern, indicating that investors and central banks alike are treating gold as insurance against a potential collapse of the fiat currency system itself. Beyond gold, Dalio's framework suggests several other portfolio adjustments. International equities, particularly in Europe, Asia, and emerging markets, offer both diversification and the potential to benefit from economic growth in regions that aren't facing the same debt crisis as the United States. Commodities, more broadly, can serve as inflation hedges and store of value assets. Real estate, while facing challenges in some markets due to higher interest rates, can provide both income and a tangible asset that tends to hold value over time. And increasingly, some investors are looking at cryptocurrency, particularly Bitcoin, as a form of digital gold, though Dalio himself has been more cautious about crypto, noting its volatility and regulatory uncertainties. There's also the question of what happens to personal debt in this environment. If you have a fixed-rate mortgage or other fixed-rate debt, inflation actually works in your favor by reducing the real value of what you owe over time. However, variable rate debt becomes more dangerous if interest rates rise to combat inflation. Credit card debt and other high-interest borrowing should be minimized or eliminated entirely. Building up emergency savings in high-yield accounts that can earn around 4 to 5% becomes crucial as a buffer against economic volatility. One of the most important points Dalio makes is about how to measure investment returns. Stop thinking in nominal dollar terms and start thinking in terms of real purchasing power. A stock portfolio that's up 20% in dollar terms might actually be down in real terms if the dollar has lost 25% of its purchasing power against hard assets or other currencies. This is the currency illusion that tricks many investors into thinking they're doing better than they actually are. Savvy investors track their wealth not just in dollars, but in ounces of gold, in baskets of currencies, or in terms of what their portfolio can actually buy. Dalio also warns about illiquid investments, particularly venture capital, private equity, and certain real estate markets. These markets are having problems because the debt these entities took on now has to be financed at higher interest rates, and pressures to raise liquidity are building. If you believe the stated valuations in VC and PE, which many professionals don't, liquidity premiums are very low right now. Dalio thinks it's obvious they're likely to rise significantly, which would make illiquid investments fall relative to liquid ones. In times of monetary stress, liquidity is king. Being able to quickly convert your investments to cash or move between asset classes is valuable, and that value increases in uncertain times. The political dimension of this crisis cannot be ignored. Dalio expects the affordability issue to become explosive politically. When people can't afford groceries, housing, or healthcare because their currency is losing value, they demand change. This typically leads to political upheaval, with voters swinging toward candidates who promise solutions, whether those solutions are realistic or not. The clash between left and right intensifies as different groups compete for a share of a shrinking economic pie. Those with assets benefit from inflation as their stocks, real estate, and other holdings rise in nominal value. Those without assets, living paycheck to paycheck, get crushed as their purchasing power evaporates. This wealth gap creates social tensions that can reshape the political landscape. History provides important context here. Dalio has studied every major debt crisis over the past several centuries, and he sees clear patterns. When countries accumulate excessive debt that they can't repay through economic growth or spending cuts, they almost always resort to devaluing their currency. It happened in Weimar Germany in the 1920s. It happened in the United States in the 1970s, after Nixon ended the gold standard in 1971. The dollar fell dramatically through that decade as inflation soared. The difference now is that the debt levels are far higher relative to GDP. And the global reserve currency status of the dollar means the impact will be felt worldwide, not just domestically. Some analysts are pointing to parallels with 1929 and the Great Depression, though Dalio is more measured in his comparisons. The key difference is that in 1929, the currency was still tied to gold, which limited the government's ability to inflate its way out of debt. Today, with fiat currencies, governments have more tools available, but those tools come with costs. You can print money to avoid default, but you can't print prosperity. The money you create dilutes the value of all existing money, transferring wealth from savers to debtors, from workers to asset owners. Looking at the mechanics of what could unfold in 2026, several scenarios emerge. In the base case, the dollar continues its gradual decline against hard assets and strong currencies. Gold continues rising, perhaps reaching $5,000 per ounce or higher. The Federal Reserve, facing political pressure and slowing economic growth, cuts interest rates more than currently expected, further weakening the dollar. Inflation remains elevated, though not catastrophically high, perhaps in the 4 to 6% range. Stock markets show modest gains in nominal dollar terms, but decline in real terms. The midterm elections bring political shifts that create policy uncertainty. Foreign investment in US assets continues to decline gradually. In a more negative scenario, something triggers a loss of confidence that accelerates the dollar's decline. This could be a geopolitical event, a debt ceiling crisis, a major foreign buyer of treasuries announcing they're dumping their holdings, or simply the mathematics of the debt spiral becoming undeniable. In this scenario, you could see treasury yields spike to 6% or higher as the government struggles to find buyers for its debt. This would cause mortgage rates to surge, potentially to 8 or 9%, crushing the housing market. Stock markets could correct 20 to 30%. Gold and other hard assets would soar as investors flee financial assets. Inflation could reach double digits. Social and political unrest would intensify. There's also an optimistic scenario, though Dalio seems less convinced of this path. In this version, pro-growth policies and technological innovation, particularly from AI, boost productivity enough to grow the economy faster than the debt. Tax revenues increase, deficits shrink, and confidence in dollar assets stabilizes. The currency finds a new equilibrium at a lower level, but doesn't collapse. Markets stabilize after an initial adjustment period. However, even Dalio acknowledges this scenario requires a lot of things to go right simultaneously, which is difficult to count on. What makes Dalio's analysis particularly credible is that he's not a doomsday prophet predicting apocalypse. He's a systematic thinker who has built one of the world's most successful investment firms by understanding historical patterns and cycles. His Bridgewater Associates manages over $100 billion using principles derived from studying how economies and markets work. When he identifies a major shift occurring, it's based on extensive research and data, not speculation or fear-mongering. And right now, all that research is pointing to a fundamental transition in the global monetary system. The implications extend beyond just investment returns. If the dollar loses its status as the world's primary reserve currency, the United States loses what's called exorbitant privilege, the ability to borrow cheaply and run persistent deficits because the world needs dollars for trade and reserves. Countries are already working on alternatives. China has been promoting the yuan for international trade settlement. The BRICS nations have discussed creating their own currency or trading system. Central banks are accumulating gold at the fastest pace in decades. These moves aren't random. They're preparation for a world where the dollar plays a smaller role. For individuals, this transition period creates both risks and opportunities. The risk is obvious. Wealth stored in dollars or dollar-denominated assets could lose significant value. The opportunity is in positioning ahead of the shift. Those who move into undervalued international assets, hard assets, and real businesses with pricing power could see substantial gains. Real assets that produce income, whether that's rental real estate, farmland, or businesses with strong cash flows, become more valuable in inflationary environments because they can raise prices to keep pace with inflation. One often overlooked aspect is the importance of skills and human capital. In times of monetary chaos, your ability to earn income becomes crucial. Developing skills that remain in demand regardless of economic conditions provides a form of insurance that no investment can match. Dalio himself emphasizes the importance of continuous learning and adaptation. The world is changing rapidly, and those who can adapt will thrive, while those who remain rigid will struggle. As we move through 2026, watching certain indicators will be crucial. Monitor the dollar index, which measures the dollar against a basket of major currencies. Watch gold prices and foreign central bank gold purchases. Track treasury yields, especially the spread between short-term and long-term rates. Follow foreign holdings of US treasuries. Pay attention to inflation measures, both official and alternative. And most importantly, watch capital flows. Where is money moving? Are investors fleeing US assets or buying them? Are companies repatriating profits or keeping them overseas? The debt ceiling debates that will inevitably occur in 2026 will be particularly important to watch. These political battles over whether to authorize more borrowing have become increasingly contentious, and they could trigger market volatility or even a crisis if not resolved smoothly. The risk is that political dysfunction prevents a resolution, forcing either immediate, drastic spending cuts or a technical default. Either outcome would be devastating for confidence in US assets. Dalio's warning isn't about doom and gloom. It's about reality and preparation. He emphasizes that we will get through this cycle and come out the other side. The question isn't whether the economy will survive. It's about how wealth will be redistributed in the process and who will be positioned to preserve and grow their assets versus those who will see their wealth eroded. History shows that major monetary transitions create massive wealth transfers. Some people and nations emerge stronger, while others decline. The determining factor is usually how well positioned you are before the transition becomes obvious to everyone. The fact that Dalio is publishing these warnings publicly suggests he believes we're at an inflection point. The trends are becoming clear enough that those paying attention can still take action, but the window is narrowing. Once these monetary shifts become undeniable to the average person, it's often too late to reposition effectively. The best assets will have already appreciated, the best opportunities already seized by those who saw it coming. In conclusion, Ray Dalio's bombshell analysis reveals that the 39% fall in the dollar against gold in 2025 isn't just a statistic, it's a symptom of a much larger systemic shift. The combination of unsustainable debt levels, political dysfunction, geopolitical tensions, and loss of confidence in dollar assets is creating what Dalio calls a debt-death spiral. 2026 promises to be a year of reckoning, where these forces intensify and the consequences become impossible to ignore. For investors and savers, the message is clear. Diversify out of pure dollar exposure. Embrace hard assets and international diversification. Focus on real returns rather than nominal returns. Maintain liquidity for opportunities. And above all, educate yourself about these cycles so you can make informed decisions rather than emotional reactions. The storm is coming, but with the right preparation and positioning, you can not only weather it, but potentially thrive. The choice is yours. Will you heed the warning and take action, or wait and hope for the best? History suggests that hope is not a strategy when dealing with forces this powerful. If you found this analysis valuable, make sure you're subscribed to the channel, because I'll be tracking these developments closely and bringing you updates as events unfold. Leave a comment below, sharing your thoughts on Dalio's warnings and how you're positioning your own portfolio. And remember, the best investment you can make is in your own financial education. Thanks for watching, and I'll see you in the next video.